I believe we are now headed in precisely the wrong direction. We are headed for more decoupling, not less, despite professions of constructive intent from Washington and Beijing. Last year at this forum, I spoke of the barriers to the flows of goods, capital, people, and technology. Some predated the current trade disputes, others are a result of it. Flows of goods, for example, have been impeded by the failure of China to open big parts of its markets to foreign competition. And they have been further impeded by unilateral or retaliatory tariffs from both the U.S. and China. Like so many others, I'm hopeful that before too long, I will be able to enthusiastically congratulate Secretary Mnuchin, Ambassador Lighthizer, and Vice Premier Liu He for accomplishing what the whole world is waiting for, completing Phase 1 of a U.S.-China trade agreement. But even when this is done, it won't be the end of the story. But it would be the first trade deal between the U.S. and China in nearly 20 years, and it's long overdue. At the same time, decoupling and flows of goods will likely continue because the idea of tariffs has been re-legitimized after taking a wallop following the dismal failures of the 1930s. The originators of America's disastrous Smoot-Hawley Tariff Act of 1930 would be ecstatic. Beyond goods, I also warned about interruptions to the flows of people. And indeed, these have been impeded by new restrictions on visas, people-to-people exchanges, and the interactions of students and scholars. But what concerns me most is what's happened to the flows of capital and technology over this past year. Both areas are vulnerable to significant negative headwinds in the form of policy changes under consideration in the U.S. and China. I will now talk a bit about those risks to financial markets and then discuss technology challenges along with proposing a few modest remedies. Financial markets function best when they are transparent and are open. And this should be an area of mutual benefit. For the U.S., which has liquid, sophisticated, transparent, and hitherto open capital markets, financial services are an area of tremendous competitive advantage. For China, which has suffered from illiquid, underdeveloped markets and too little transparency, this is an area that has been largely closed to the world for too long. This has contributed to the misallocation of capital, inefficiencies in hidden debt, and risk across the Chinese financial system. But there is some good news. China has begun to open its capital markets, and the impending trade agreement has important new provisions related to foreign ownership. Opening offers American and global firms the opportunity to contribute to developing China's capital markets. And that would be important in moving China toward a market-driven economy and a market-priced currency. Financial openness in China and the opening of China's capital markets would also facilitate the development of China's national carbon market. This has more potential than just about anything to reduce carbon emissions in China and mitigate a formidable and certain risk to the economic security and social stability of China and the entire world, while creating new opportunities for environmental goods and services and financial products. But none of this will happen if we continue on a trajectory of financial decoupling. Put simply, China must open further. It needs to resist the defensive temptation to protect domestic firms that would become stronger if they are subjected to best-in-class foreign competition. But Washington needs to resist some temptations too. Decoupling China from U.S. markets by delisting Chinese firms from U.S. exchanges is a terrible idea.